Hello, and welcome to Portfolio Matters Weekly Markets Checklist Week 218. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Well, it's another busy week, I'm afraid. First of all, the news. So, China has launched a new regular shipping service going around the north of Russia via the so-called Ice Silk Road, and that will halve transit times between China and Europe. So the first vessel to use this new route is actually traveling between Ningbo and Felixstowe. In the background, the Ukraine war grinds on. The Ukrainians have been continuing their drone attacks on Russian oil refineries and Wildberries warehouses. And I didn't know this actually, but they have regained 745 square kilometers in the Ole- Oleksandrivsky region following a successful counterattack. So
That's
great.
quite a chunk, isn't it?
Yeah. Um, Now, in Gaza, Trump had proposed a 15-point peace plan, and there was lots of fanfare when Hamas committed to the peace plan and to disarmament, but then Israel rejected it. The US Senate passed a new Russian sanctions bill by a big majority, and that would allow the president to impose tariffs of up to 100% on countries heavily dependent on Russian oil and gas, potentially China, India, and Japan. Will he do it? Will he, as the Iran war continues and he needs to put further pressure on Iran, will he use his new powers to put further tariffs on China? Question mark.
I would just nip in there, Keith, and say this is the it's like the thrashing around of a failed state, looking
Yes.
for more and more extreme solutions to a problem of their own making. And you can see that the unintended consequences of doing like that, something like that, would be absolutely massive, pretty much
Yeah,
unpredictable. And China would not sit back and just let it happen. Neither would India.
I
And
agree.
obviously neither would Japan. And actually, the US is highly dependent on Japan at the moment because they don't want Japan selling all of its US treasuries. So this is just basically discontinuity, disruption, and it would be more failed US policies and would contribute to its decline rather than reinforce its strength. It's just
Yeah,
bizarre.
yeah. Well, he's got the powers. He won't necessarily use them. Let's see.
Yeah.
Nvidia is planning to create a 500 billion enormous fund which will provide financing to its customers and allow them to continue building AI infrastructure and essentially buying Nvidia chips. It's part of the circular AI economy. Much
Mm.
more on that coming up. The US and Japan intervened in FX markets to support the yen. So the US sold euros and bought yen to stop the yen from rising through the 165 level against the US dollar. So the yen would then be weakening as its rate against the US dollar rose. Um, and the yen has since retraced about half its gains after that intervention. Meanwhile, as I'm sure you're all aware, extreme weather in Europe continues. The water level in the Danube is close to record lows. 15% of French nuclear power stations are offline as they can't extract water from the rivers to cool themselves sufficiently. And wildfires have been everywhere, as I'm sure you're all aware.
I
Right,
was
go on.
sorry, I was listening to Farming Today this morning, as you do, living in the middle of London, and they had a farmer on who said that in the spring there was 55 days with continuous rain, or
Yeah.
55 days where there was not a break in it. It rained every day, sorry. And he said, our problem is we don't have enough. It's not that we don't have enough water, it's that we're very bad at managing the water.
So it's that we're very bad at managing water.
Very bad at managing water. It's not that we don't have it. That was the point of view of a farmer.
Yeah, I think that's true. So this chart shows the new Ice Silk Road, which allows Chinese vessels to go north rather than south and via the Suez Canal, and thereby halves transit times. That is potentially very good for transport costs.
So is it assuming, Keith, this is just a summer route?
Yes, that's right. And apparently the vessels are strengthened so they can break through ice.
Mm.
And this is from the Institutes for the Study of War. And the blue area is land that has been recaptured by the Ukrainians in their latest offensive. Now, the offensive has been lasting from January to August, but if you look at the little inset map, you'll see they've made actually quite a lot of progress in northern Kharkiv. This is water levels in the Rhine. I mean, record lows. And that means transport up and down the Rhine, so coal, etc., is going to struggle. So that has imposed costs throughout the economy. And this is the yen versus the dollar. So it was threatening to breach 165. The US and Japan intervened in a coordinated manner, strengthening it by about 8%, I believe, from memory. But it's since retraced some of that. The FT this morning were talking about the structural weakness of the yen, and we talked about this previously, how on a PPP basis it should be about 97 rather than 159. But they're saying if you wanted to strengthen the yen, then you'd have to raise interest rates, which would weaken the economy. So the Japanese are stuck in a bind if they either accept the weak yen, or if they try to deal with it, they are likely to suffer weaker growth. And the markets are concerned about Japanese fiscal sustainability, and in order to fix that, they need stronger growth.
Yeah, and but also if they raise their interest rates, then was it debt to GDP like 250%?
Yeah.
I mean, they're between a rock and a hard place, and they screwed themselves years ago.
Yeah.
They shouldn't have done it. It was bonkers. But
Well,
they have done it, and it's very hard to see how they get out of it without a fairly significant disruption.
no, I totally agree, Richard. To me, they should have accepted they were stuck in a low interest rate, low inflation environment, and thereby their enormous debts were sustainable. Their problem was they then decided to try and get inflation up to 2%. But, if you have debts of 250% of GDP and you get inflation up, then your interest rates are going to rise and your debt is going to become unsustainable. And we talked about this, years ago, but they've now shot themselves in the foot. And I don't really understand what their plan was, because interest rates were going to rise, which was going to make the debt unsustainable.
Yeah, I mean, we know we've talked about this for years, haven't we, Keith? And the chickens are sort of gradually seem to be wandering back towards the roost.
Yeah. So I don't think I think the yen will continue to weaken. I can't see a way out of it, basically. And because it's not as though they're actually getting the fiscal deficit under control. I mean, the Takichi is loosening the strings again. Yeah.
And the bizarre thing, do we talk about this later? Or
No, carry on now.
the bizarre thing is that Vesant sold euros in order to buy Japanese yen.
Yeah.
And I think the ECB is pretty cheesed off with that. But
Well,
it shows the fact that they don't want to further undermine the US Treasury market. They're really nervous about doing that.
no, that's true. That's a good point, actually. In the case of the euro, though, the selling euro bonds, I mean, it's another example of them disparaging the Europeans, isn't it? Not
Yeah,
supporting them.
indeed.
Now, this is interesting. So, in Australia, this guy used an AI agent. What he wanted to do was book himself into his local gym class, and he asked OpenClaw to go and do it for him. OpenClaw found that the gym class was full, so they essentially hacked into the website and kicked somebody off and put him in the gym class. When he discovered this, he asked them to undo it, and they couldn't because the bug they'd exploited was a one-way security bug. So if you read the green inset, that is the response of OpenClaw, basically saying, bad news, I can't add them back. The cancel reservation option that was missing an authorization check that allowed them to do this is a classic one-way security bug. So essentially, these AI agents are going to have the potential to cause chaos amongst lots of websites if there's these previously undiscovered security flaws.
There's going to be a massive industry growing up, Keith, isn't there, to test all of these systems for AI discoverable security flaws.
Yeah.
The
And
remarkable thing is how effectively they discover them.
yes, absolutely. And the thing is, this guy is a benign actor,
Yeah,
you know?
yeah.
Now, on to war news. Now, 2 weeks ago, the US was guiding that it was expecting to reach an agreement with Iran within days. So we were recording on the Monday, and Trump was saying we could have a deal by tomorrow or Wednesday. Well, that didn't happen. At the time, Iran and Oman were negotiating to control the straits between the two of them, and the US appeared to be anticipating that that agreement would lead to a reopening of the straits. Well, those negotiations concluded, but Iran then stated they were not going to reopen the straits, and that those negotiations were separate from anything to do with reopening the straits. It then issued a whole series of demands against the US, which were maximalist. So, a permanent end to US wars against Iran and its allies in Lebanon, Palestine, Yemen, and Iraq, lifting the naval blockade and withdrawing US forces from the region, 300 billion in compensation for war damages, lifting of all sanctions, unconditional release of all frozen assets, Iran's right to charge up to 7% tolls on cargo going through the straits, a ban on US and Israeli vessels going through the straits, etc., etc. So there's no way the US could agree to any of that. But Donald Trump has not responded with further attacks on Iran. He is reportedly hoping that economic sanctions will force Iran back to the negotiating tables. And he has claimed in tweets that the US fully controls the straits and Iran should be paying the US compensation.
Mm.
Um, Iran has now threatened to keep the straits closed until the next American presidency. So going well then.
What can you
Um,
say?
yeah, elsewhere, Ukraine continues to attack Russian oil refineries and oil export terminals, including the latest one at Novorossiysk. on the Black Sea. Now, that came after Vice President J.D. Vance had specifically asked the Ukrainians to stop attacking oil tankers in the Black Sea because it was impacting US oil companies carrying oil from Kazakhstan. So, what the Ukrainians appear to have done is then not to have attacked tankers, but instead to have attacked Novorossiysk, avoiding US owned assets.
I think the problem here is that by attacking all these Russian oil fossil fuel assets, they are making the shortages far, far worse. And it's actually absolutely against US interests for this to be happening. And the US must be getting very, very irritated with Ukraine.
Yeah, well, as we talked about last time, the Ukrainians have a history of signing whatever they need to sign, but then doing what they need to do to further the war. And the fact that Trump has reneged on his previous commitment to give them Patriot missiles, presumably doesn't make them more willing to obey his their commands.
No.
Now, and elsewhere, further pressure on the oil system in that Libyan oil refineries on the Mediterranean coast have suffered from drone attacks. No one has claimed responsibility, and this is likely warring militias within the country rather than external actors. But the state oil company has warned that any further attacks may threaten oil exports and cause them to issue a force majeure notice on oil exports.
At least we've got our ducks in a row in the UK, Keith, and we're now pumping the necessary oil and gas that we need to sustain our economies whilst moving towards reducing our dependence on fossil fuels. So, at least we have that policy firmly in place and we know what we're doing.
Yes. Actually, on that point, have we actually agreed? Has Burnham actually said that we will be pumping more oil?
I don't think he has a choice. I think he has to say we will because he hasn't. But I don't see how he can not do it because he doesn't. I think his heart's in the right place. His competence remains to be seen, but he doesn't want to turn the UK into a dependency on foreign oil where there's a huge continual shortage of it. So he has no choice, does he? And I mean, I was listening to Zach Polanski on the radio the other day, and he's like, I do think he's like a used car salesman. He's got the gift of the gab. He says all sorts of stuff. But what irritated me was being interviewed on Radio 4 PM, and I was listening because I was in the car, was that the presenter was just accepting this. He wasn't challenging any of the stuff that Polanski was coming out with. He was just accepting it. But actually, what he comes out with doesn't bear analysis in any way whatsoever. But it sounds jolly good if you don't think about it. And so the problem is that we've got a lot of people who are spouting nonsense. And actually, for the security of the country, yes, we need to continue to move away from fossil fuels, but we actually need to produce our own fossil fuels. It's a no-brainer, isn't it, Keith? I know you know, but it's like,
well, absolutely. I mean, because the reality is we still use this stuff.
Yeah,
so instead we're importing it from all around the world
at great cost, or with great insecurity of supply. And actually, we'd be able to get off it quicker if we produce our own and keep ourselves properly supplied at a decent price, and we would actually be able to move off it quicker. And if we don't, it's like they've got the whole thing backwards. This is there's absolute absence of critical thinking amongst the political classes.
Yeah, well, common sense does not necessarily mean they're actually going to follow through with the policy of opening up the North Sea. I mean, Ed Miliband has targeting net zero, at vast cost. And cost to jobs and our balance of payments.
Don't talk to me about Ed Miliband.
Okay, moving on.
He's put it somewhere relatively harmless, hasn't he? Because actually now the UK has diminished itself so much. Foreign Secretary, it's a bit like remove foreign and just put in Secretary. Especially Ed Miliband. So Ed Miliband had to meet Trump, didn't he? And I think an interviewer said to him, "So, do you still think he's a narcissistic misogynist?"
Cool. What did he say?
I don't know. I didn't hear the answer, but I read the question. I didn't actually, hearing Ed Miliband trying to get out of that one. No thanks.
Yeah, yeah. Um, so this is a tweet from Donald Trump in which he says the USA has total control over the Straits of Hormuz. I don't think he has. But he is not bombing Iran. Instead, he is calculating that US sanctions on Iran and the blockade of its oil exports will put sufficient economic pressure on the country to force it back to the negotiating table.
They're probably trying to stir it up, aren't they, with agent provocateur?
Yeah, they probably are, but the reality is the hardliners are now in charge. The regime are now in charge, and they're perfectly willing to shoot anyone who
Yeah.
dissents. Now, pause, have a look at the table on the left. Certainly, Iran is suffering economically, and Scott Bessent has today, I think, or last night, said that the US would be putting the hardest sanctions on Iran of any country in history. Well, it's difficult to see how much harder they can get, frankly. The reality is that it hasn't worked so far, and essentially, the US strategy is to allow sanctions and time to put pressure on Iran, and Iran's strategy is to allow closure of the Strait and time to put pressure on the US. So in both cases, the Straits would appear to remain closed for a long
Yeah.
period of time.
And actually, Iran has got that time because it's not very long, is it? That it has to survive the current situation
Yes.
before the midterms. And of course, the Houthis are doing their damnedest to disrupt the Red Sea now and
Yeah,
Saudi exports via the Red Sea.
absolutely. So last week I was trimming my oil positions thinking, oh, they're going to get a deal. And then the moment the Iran turned around and said, no, we're not going to open the Straits, I put them all back on again.
Wise move, Keith. So what's interesting is they have, I say they, the hidden people in the US who have been manipulating the price of oil down are no longer able to do so. So they tried to get it below 80 yesterday and failed, and now it's up 1.75% this morning. So the shortages are actually starting
Yeah.
to be properly reflected in current delivery prices.
Yeah. Yeah. Much more on that in
and
a
I
bit.
think the price of oil.
So this is the Ukrainian attacks on the Novorossiysk um, oil export terminal on the Black Sea. Um, these attacks are getting further and further away from Russia. And I thought this is a very interesting chart. So this is Ukrainian and Russian strikes in the war. And you'll see the top chart is Ukrainian strikes on Russia. You see that the drone strikes have been very steadily increasing over the course of the war. And just look at the absolute number. So this is per month. You're talking about 5,000 a month. And these are running at twice the rate of Russian ones. So Ukraine is winning the drone war. And it's hitting, I don't know how it's doing this, but it's hitting refineries 2,000 kilometers away
So
in the middle of Russia.
these drone skis, assuming they're not being launched from close by, and I suspect they're not anymore because I think that's probably too difficult now. They must be big to have a range of
Yeah.
2,400 kilometers.
I mean, I fail to see how you can get a drone with sufficient fuel to make it that far. But
it's more like the US Reaper. I don't know how far that can
yeah,
fly. It's more like something like that, isn't it? I mean, it's probably
must be.
much less sophisticated, not as big, but it must be that. But of course, the bigger it is, the easier it should be to shoot down.
Yeah, I know. So, fair play to the Ukrainians. They're doing an absolutely amazing job. They've taken roughly 40% of Russian oil refinery capacity offline. But despite all that, actually, when you look at seaborne crude, um, Russian exports have they've grown year on year. So what's happening is that Ukraine are hitting Russian oil refineries. So because they can't refine the crude themselves, they're exporting it and then they're trying to import refined products.
Oh, right. Yeah. So a lot of that goes out through pipelines, doesn't it?
Yeah. But this is seaborne.
Okay.
And Russia is also sending seaborne exports via the Arctic round to China, and thereby avoiding, interception, possible interception by NATO countries targeting their shadow fleet. So this is Libya, um, and there have been drone attacks on Zawiya here, the oil export terminal. And obviously, there's been an ongoing civil conflict in Libya. And if that gets worse, then potentially Libyan exports also go offline. And the drone attacks also on desalination plants. So quite nasty. The longer
Hmm.
this war goes on, the more countries like Iraq, who's got a lot of shut-in production, will be investing in alternative pipelines. Now, these are the proposed pipelines. The trouble is, in order to commit to these, you're talking about a huge investment and several years of construction. And you're only going to do that if you think the straits will remain closed for years. Otherwise, you just go back to sending it through the straits. So I'm not convinced that these pipelines will actually come to fruition.
And they take several years to build, don't they? So it's not so they can't sort of put them out in
Yeah,
a few months.
absolutely. And
So it
also,
doesn't solve the problem that we've got in anything like the near term.
precisely, and also it goes through Syria, through the and skirts northern Lebanon. So, the
Not
this is not.
entirely stable, is what you're
No,
saying.
exactly. There are risks to that as well. But on Richard's point, the traffic through the Bab el Mandeb has been disrupted by Houthi attacks on tankers, and they have absolutely been firing missiles at Saudi tankers, hitting them and killing people. And now they seem to be just targeting Saudi vessels. So if you look at the middle chart, that shows Saudi transits through the Bab el Mandeb. If you look at the rest of the world, actually not that affected. Now, let's go through a status report on the war. And Iran has been keeping up its attacks on its neighbors recently, attacking that Iraq, but fatalities have been very low. It has, though, been maintaining a steady count of attacks on ships going through the straits or just outside the straits in the Gulf of Oman, sufficient to deter anyone but the most committed vessels from going through it.
It's a clever strategy, isn't it? Just sufficient to keep everybody's heads down and to stop transport and shipping, but not using up any material amount of missiles and drones.
Yeah, and it's the strategy is to keep insurance costs very high,
Yeah.
and it's working very well. Meanwhile, Israel and the US have stopped attacking Iran. Visible, and I repeat that, visible traffic through the Strait has collapsed and shows little sign of improving. The red is crude tankers. So tankers with their AIS on have there aren't any basically going through the straits. And tanker hire costs have risen and continuing to rise. Now, Chinese oil refinery rates are rising again, which suggests that they have been running through their inventories of refined products and are having to get to work again. That's interesting. Is China now going to have to start buying oil in international markets? If and when they do, the oil price will start to rise relentlessly.
Yeah.
But as it is, as of July, their imports had continued to fall. So, oil market proving more resilient than we had expected. Around 6.5 million barrels of Middle Eastern oil remains shut in. And you'll note that this excludes Iran. Futures markets are now pricing in oil to remain above $70 a barrel for the next year. Gasoline prices in the US remain very high. Problems for Trump as he heads towards the midterms, as do diesel prices. They're not coming down. Jet fuel prices are well down from their highs, but still double what they were pre-war. Refiners are making absolute mint from a record crack spread. Reminder, the crack spread is the difference between the price of refined products and the price of oil, input oil. So it's how much refiners make. Fertilizer prices, amazingly, are back down to their pre-war levels, despite the loss of up to 40% of world urea supplies. Next episode, we'll go through agricultural prices because the UN food price index has apparently been rising again.
Keith, can I just going to chip in here because I found this fascinating. So because of all the refinery, etc.
Yeah.
Refining. So petrol is 4 to 12 carbon atoms, a mix of hydrocarbons of 4 to 12 carbons long.
Yeah.
Diesel is 12 to 20 plus.
Yeah.
And jet fuel is about 12 to 14.
Oh, right. I didn't know that.
Jet fuel actually is the lighter end of diesel, or the heavy end just beyond petrol.
Oh, right.
So that's why jet fuel and diesel effectively come out of the refinery together, which is why there's a jet fuel and diesel problem at the same time, but not a petrol problem. So I would have thought that jet fuel was quite light, but actually it's relatively heavy.
Yeah, no, I didn't know that. But what I do know is jet fuel, it's designed basically so that it's that hydrocarbons are branched so they burn easily. Anyway,
I didn't know that.
Suddenly in the last few days, and I've tried to find out why and been unable to. If you know this, please get in touch. But the odds of the Democratic Party winning both the Senate and the House have shortened dramatically, and the Democrats are now favourites to win the Senate, and that would put a lot of pressure on Trump's agenda and could lead to him being impeached.
Absolutely. Inevitably lead to him being impeached. I think on probably half a dozen different counts now. I'm not prejudging, but that's the Dems will go for him. Absolutely.
Yeah. Now, I've also read actually that various people saying that Trump won't attack Iran until after the midterms, and then he'll really go for them. So it seems to be the US is not going to do anything about the Straits until after the midterms. That's the 3rd of November.
Can I tell you about jet fuel?
Yeah.
It's quite interesting. So jet fuel, you're quite right, because jet fuel contains a large percentage of branch carbon chains called isoparaffins or branch alkanes.
Yeah.
And it helps prevent freezing because straight chain hydrocarbons pack together more tightly. It makes freezing and turning to wax more likely. So they're high up. So they help prevent freezing. It controls the boiling point. Branching helps fine-tune the boiling point of volatility, preventing the fuel from evaporating too quickly. And it also gives a cleaner combustion because they just burn more cleanly, don't create excessive soot, and they cause less soot damage to the jet engines.
Yeah, that's right. It's good because they're branched. They're in the combustion process. They tend to disintegrate into smaller hydrocarbons.
Yeah, that's fascinating. I knew none of that.
Yeah, chemistry degree, mate.
Oh, well
Anyway,
done.
I never used it. This is probably the first time I've used it in 40 years. Anyway,
Well, you never know when it's going to come in handy, do you?
so stockpiles are drawing down. Now, when we go through this, you'll see actually there was a US crude build over the past few weeks.
Well, was it a
Which
bill
is
or was it
yeah,
a manipulation of numbers?
yeah. Well, odd. So, in summary, no end in sight. Both sides' strategy seems to involve time. So the US plans to basically just keep sanctions on Iran until they come to the table. Iran's going to keep the straits closed until the US capitulates. So straits closed for longer. Um,
Yeah.
I'm staying long oil, and actually, I'm feeling quite relaxed about it. Now, separately, the US has claimed that it is in total control of the Straits of Hormuz, and that depending on which American official is talking, that either 9 million barrels, according to Energy Secretary Chris Wright, are getting through the Straits quietly every night under US protection, or other people have claimed 8 million barrels a day. Is that remotely plausible? Now, reminder, this is Goldman Sachs' assessment of the current situation. So, prior to the war, you had flows of approximately 23.1 million barrels coming out of the region, the Persian Gulf countries. They think we're seeing disruption of 13.4 million barrels, and that includes flows through Hormuz of 3.7 million barrels a day, plus zero point 0.8 million barrels of ship to ship transfers in the Gulf of Oman. So a total of 4.5 million barrels. So Goldman Sachs are accepting that oil is sneaking out.
Mm.
So there are various sources for what's going through the Gulf. Kepler monitored traffic flows in and out of the Gulf, including by vessels that have turned their trackers off as they transit. And they give you very detailed routing information. So what you'll see is ships in green heading towards the straits and then disappearing as they turn their AIS off and then reappearing on the other side. Now, Kepler estimate that only around 1.7 million barrels a day are
Mm.
going through. However, other independent researchers put the flow much higher. So it's not clear how they're calculating implied flows. But here we're seeing assessments of around 5 million barrels a day, although it is volatile. Some days you're getting loads going through. Commodity Context estimates flows are close to 6 million barrels a day, but you'll notice they've been falling recently. So they surged again when a ceasefire seemed imminent, but they've been fading again. And as Roy Johnson points out, there aren't enough tankers going back in to sustain 8 million barrels a day of outflows. You can have a surge as trapped vessels escape, but they ain't going back to facilitate flows. So let's return to the Goldman Sachs chart. And if we assume that 6 million barrels is coming through, then we're still short 11.9 million barrels a day. Seems a lot to me.
It seems an awful lot. And that's about 1.5 billion barrels if you just average it out over the 5-month period, that's about 1.5 billion barrels that hasn't gone onto the world market.
Yeah. And separately, the EIA estimates that about 10 million barrels a day were offline in July. So,
So does that make the US build believable, Keith?
well, the thing is, that will depend on how long, say, oil tankers that have escaped the Gulf took to transit the Atlantic, and also just the idiosyncrasies, and just the idiosyncrasies of, let's say, flows from Venezuela plus oil exports, which have been falling, etc. I don't know.
Yeah.
But what's true is overall global oil inventories must be falling over the period. And on to economic news. So not much economic news over the past couple of weeks. UK, we had Q2 GDP numbers, which beat expectations. Hurrah, at 0.4% Q on Q, 1.2% year on year. Not great, but actually, that is around trend GDP growth potential. So the UK is growing in line with its average performance, which is low. UK business investment massively beat expectations at 1.7% quarter on quarter, plus 0.8% year on year, and that is mainly IT investment. So the UK is benefiting from the surge in AI infrastructure spending. Industrial production fell 0.2% year on year in June, and the trend is relentlessly down. Higher gas prices, not good for UK industry. UK construction output fell 2.3% in the year to June. Higher interest rates and higher costs are having a negative effect on UK construction. Turning to the EU, not much data. Retail sales were down 0.3% month on month in June, up only 0.7% year on year in the year to June. Not great. Industrial production basically 0.1% year on year, going nowhere. Construction PMI 44.3, again in contraction territory. Much more data from the US. So we had inflation numbers which were benign. Better than expected at minus 0.1% month on month in July, despite the resurgence of the war in Iran. 3.4% year on year. So 5 years, the US inflation has now been above 2%. Core was at 0.2% month on month, 2.5% year on year. US non-farm payrolls missed expectations at minus 23,000 in July. So US having net job losses in July, and further confirming weakness in the jobs market. Average weekly earnings growth missed expectations at 3.2% year on year. Productivity growth was 1.4% annualized in Q2. So US earnings growth is perfectly compatible with the 2% target. The participation rate, though, continued to fall in July. That meant despite the loss of jobs in July, the unemployment rate actually fell to 4.1%. Job openings also continued to decline. Market news, well, despite the higher oil prices, equities did all right over the past couple of weeks, as good, strong Microsoft earnings led to a rebound in tech. So the oil world was up 3.7%, up 14.2% year to date. NASDAQ massively bounced, up 5.6%. The S&P 500 is at new all-time highs. Brent was up 5.1%, up 44% year on year. Sadly, European natural gas prices continue to rise, up 8.4% over the past couple of weeks, up 11.5% year to date. UK natural gas prices also rising. US natural gas prices not rising. Um, Industrial commodities a bit meh, not much going on. Um, Lithium had a bounce, but has been falling from highs. Copper continuing to rise. The main action was in precious metals, where gold was up 6.5%, silver up 10.5%. So, reversing recent weakness, we have our SimonW's technical analysis of both gold and silver coming up. Bond yields, unsurprisingly, high and rising. And, bond yields don't take rising oil prices very well. So the risks remain to the upside. Some charts related to markets. Well, after the weak July non-farm payrolls report, the markets are expecting just one rate rise in the coming year. And so this is the table of futures, and markets are now expecting one rate rise in December, and then US interest rates to remain at that higher level for the whole of 2027. So then they're saying basically the neutral interest rate for the foreseeable future is 375 to 400. So borrowing at 400, lending at 375. And on to equities, Richard.
Thank you, Keith. So over the past 2 weeks, the FTSE All World has done well, up nearly 4%, and the FTSE All Shares unchanged. The stocks Europe up a little bit, 1.5%, S&P 500 up a stonking 4%, as is the Russell at 4.2%, and as Keith said, the Nasdaq up 5.6%, and Hang Seng down to 2.6%. The topic's up 6%. Bitcoin just up 0.8%, and the pound against the dollar, euro against the dollar, pretty much unchanged. Dollar index pretty much unchanged, and dollar index unchanged on the year. And what I do not understand is how every commentator and his wife is saying, that's not meant to be sexist, by the way, is saying that the US dollar is under pressure and the dollar index hasn't moved this year.
I agree.
It's like these people are just out there trying to create news out of something that doesn't exist. The dollar is not declining. It's not going up. It's stable.
Yeah, that's true. Relative to other currencies, but the whole basically fiat currencies in general are declining relative to gold.
Precisely, but you get a lot of nonsense talked about why commodities are going up because the dollar's falling. The dollar isn't falling, and people have just got this mantra in their minds that if interest rates go up, the dollar goes up, therefore commodity prices fall. I mean, it's just sort of, it just makes no sense at all. So you get so much twaddle spouted, including in the Financial Times, actually, which irritates me intensely. And then finally, having had my little rant for the week, the VIX was down nearly 9%.
This is absolutely. So two things. Topics continue to rise despite the yen strengthening, which is amazing. But also VIX, given the war in Iran and all the uncertainty in the world, the fact it is, just amazingly low shows markets are astonishingly complacent to me.
Well, I suspect the dead hand of the US government is involved in it somewhere along the line as well.
Well, because the other thing I'd say, Richard, we've been talking about how, we're entering a traditional period of volatility, actually August, September, October.
And everybody is saying the US market's overvalued and we're going to have a crash and so forth. I don't believe it because the US government won't allow it to happen. They'll go in and they'll buy futures and so forth.
Right. Yeah.
Just like Japan did with it. So how much of the Japanese stock market does the Japanese government own?
Yeah, that's very true.
So this is a FTSE All World Equity Index.
Still rising.
FTSE All Share. The Euro stocks. S&P 500.
Yeah, strongly bounced back from its recent weakness.
The Nasdaq.
I still think we're in a topping formation, despite the fact the S&P 500 has hit new highs.
Mm.
Broken record from yours truly.
The Russell 2000. Well, I don't disagree with you that everything's too highly valued. I just think that
Yeah.
the US government won't let the stock market drop,
Yeah.
or will do its absolute damnedest not to let it drop.
I'm sure that's true, Richard. The Russell 2000, that looks just a steady climb, and that implies the US economy is doing just fine. Thank you very much.
Yeah. The Hang Seng.
Fading again.
Topics doing very well because Japan is an economy that's firing on all cylinders. Uh, Bitcoin, pound against the dollar, and the euro against the dollar, and the dollar index.
Yeah, stable. If anything, it's up on the past year, so
Yeah. And there's the VIX.
unbelievable.
Mm.
That's just incredible. We've got a war on. We've got three wars on.
Yeah.
Uh, it's amazing.
So Microsoft had good results, sales up 18% year on year, and revenue from their Azure cloud computing up 32%. So OpenAI's share of Microsoft business is about 70% of its actual AI sales. So it is highly dependent upon its very close relationship with OpenAI.
Yes.
Or it's highly dependent on OpenAI doing well because of its very close relationship.
Yeah. Well, highly dependent currently on OpenAI still being able to borrow loads of money to fund its investments because it ain't
Yeah,
making any money.
yeah, we shall see. So optimism is returning in the AI trade, so that all the AI companies are up a bit in their pricing, and of course there's a big interest in people trying to get these IPOs away to have a lot of froth in the market because that will facilitate getting the IPOs away. So doubtless there's a bit
Yeah.
of carefully judged buying and selling going on. The Philadelphia Semiconductor Index has bounced 18% from its lows.
Yeah. Not at new highs, but
The Kospi is bouncing nicely.
yeah, I definitely think that is game over though. That's just
A big drop, didn't it? To
yeah,
say
it's the biggest rallies are in bear markets. It had an 18% rally in a day. This is like standard stuff.
yeah.
End of a bull market.
And so the credit market view of hyperscalers is not great, which is the opposite of the equity market's view of the hyperscalers. So credit spreads are widening
Yes.
as equities bounce, and the market has breadth.
Yeah. Yeah. So actually, the market is doing all right.
Mm.
70% of S&P 500 stocks are above their 200-day market moving average.
Yeah,
That suggests the bull market is back on and it's got legs.
it does. Earnings forecasts are remaining strong and are rising very significantly.
Yeah. Look at that. That's just an amazing chart.
There we are. So the S&P earnings growth estimate paths.
So markets have their expectations for 2026 earnings have been going through the roof over the past few months.
Yeah.
Remember the Kalecki-Levy model? That implies massive AI investment and a growing US deficit, both of which are true.
Let's see, S&P 500 net profit margin currently at nearly 17%, way above the long-term average of, well, I say long-term average, the medium-term average of around about 12%.
Yeah. Years and years ago, Warren Buffett said that long-term average profit margins were about 6%, and anything above that was unsustainable.
Mm.
Well, the guru got that one wrong.
We did actually, because it's been above that for a long time now.
Yeah.
Markets still expecting strong EPS growth, as we discussed earlier.
Yeah, look at that throughout 2027.
And of course, expectations doesn't necessarily mean it'll happen, but there's a lot of bullishness around.
Yeah.
And The other 493, apart from the Mag 7 stocks in the S&P 500, also have strong earnings growth projected. Or they
Mm.
also have strong earnings growth, actually. Credit spreads generally low and credit conditions are loose. Junk bond spreads have been rising steadily since the beginning of 2025.
Yeah.
They're not excessively high, but they are at the
No, they're
top end
not.
of their range.
Yeah.
And outstanding stock margin loans have declined in Asia,
Yes. They're
which
still
is
pretty big, though.
which is quite healthy actually.
It is. Absolutely.
And post-COVID growth has far outstripped free cash flow. So the cash, well, is it balance sheet manipulation or is it investment in assets, fixed assets?
Yeah. Well, this is the question, isn't it? The reported earnings per share, how real are they?
Yeah,
How real are those earnings when, you're investing a lot of those earnings in assets which they're clearly hoping will earn an economic return, but more on this later. We are skeptical.
yeah. Will they really?
Will they really? Reminds me of .com, you know.
Yeah. So dividend yield on the S&P 500 is the lowest. It's lowest in history. It's averaging sort of around about 3%. It's currently 1%.
Yeah.
So it's all capital growth.
Yeah.
And severe market drawdowns happen roughly once in a generation.
Yeah. But you see, your 20% drawdowns are not actually that rare.
No, but 50% drawdowns. The last one was what, 2008?
Yeah.
And there was 1977-ish.
Yeah. Yeah. God, look at that.
And then Second World War. And then the 1930s.
Yeah. But people forget the 1937 drawdown, actually,
Yeah.
which is there.
So we haven't had one for a while,
Yeah.
2008, but that's not unusual at all.
Yeah.
In that sense, it could be a long, long time. It could be another 10, 20 years before we have another one.
It could be. I don't think it will be. Anyway, been predicting a bear market for a long time, and I continue to be wrong.
We'll be old and grey by then, Keith.
Yeah. I thought we were there already, mate. So, crypto.
I'll give you the lines you made the show. That's
So,
interesting, isn't it? Crypto
yeah,
trading. Sorry, Keith.
it's just dying as far as I can see. Don't need it.
I watched the share price of MicroStrategy because I'm quite interested in it.
Yeah.
And there's undoubtedly some shenanigans going on with it because it goes up 10% while the price of Bitcoin's done nothing.
And okay, so the big theme of the moment is AI investment. It is propping up the economy, etc., etc. So Goldman Sachs estimates that AI investment will be around 600 billion in 2026, around 1.8% of GDP. That is a huge boost to the US economy. And I mean, I find this chart just astonishing. They're expecting it to keep growing in the coming years and then to maintain that growth for until at least 2030. I'm deeply, deeply skeptical. But they have lined up 2.6 trillion of future spending. So these are commitments they've made to spending. Leases not yet commenced. Now, these are enormous future spending commitments. And the result of this is that the AI build-out is delivering the largest capex-driven boost to GDP in history. It's actually the biggest, I think, on the global scale in world history. And contrary to what I certainly have heard, data center construction is not being curtailed by bottlenecks in turbines and power generation. In fact, they're on schedule. Like projects started in 2026 are actually ahead of schedule.
Yes, the proof of the pudding case is data centers coming online, isn't it?
Yes. Well, more on that in a bit. The thing is, when you look at how sustainable this is, the recipients of AI capex are making huge margins. So this is Nvidia, SK Hynix, etc. All the semiconductor manufacturers, they're making huge margins and massive profits. But their customers, the people actually doing the investment and are buying chips, etc., Apollo estimates they have a negative profit margin of minus 59%. So essentially, the profits of the chip makers are all coming from investors. And in order to keep this circular flow going, NVIDIA has been in discussions with Apollo, Blackstone, and Goldman Sachs to provide a 500 billion AI financing facility, with NVIDIA providing a backstop for up to a quarter of the deals. So essentially, in order, it's going to finance its customers so they can buy NVIDIA chips. This is
What could
how
go, what
gone.
could go wrong, Keith?
Well, exactly. They're leveraging their balance sheet essentially in order to allow their customers to buy chips, their chips. There you go. The AI ecosystem, circular flows.
Hmm. Yeah.
Meanwhile, credit markets, equity markets are off to the races, as you know, they're all reporting fantastic profits. Um, but credit markets are becoming more concerned. So these are the 5-year credit default swaps on Nvidia, Meta, Broadcom, Alphabet, and Amazon, and they've all been rising. They're not, to be fair, they're not very high yet, but the trend is not great. If you look at the right-hand chart, this is data center CDS, and rising quite very quickly, although it has been much higher. Hyperscalers, relatively, I mean, it's been rising, but they're still relatively low.
Yeah.
Meanwhile, token costs are down 37% from their peak. So the whole AI trade relies on customers eventually paying enormous amounts for AI. This chart suggests actually they won't pay infinite amounts. And when you break it down, you'll see that token spending for closed models, i.e., Anthropic's, Claude, OpenAI, etc., has been falling. Token spending, token costs for open models, i.e., those cheap Chinese models, it's been rising. And when you look at token usage, you're looking at the brown bars at the bottom here. That's DeepSeek, and then the red ones are ZAI. That's also Chinese. You'll see Chinese models have been growing very rapidly, and they don't charge for using the model. They may charge you for hosting it, etc., but the actual model itself is vastly cheaper. Bottom line is, we're in an investment boom of absolutely unprecedented scale that's supporting the US and, frankly, the world economy. When you look at UK GDP, it has been boosted in the past quarter by information technology spending, the services sector. The equity markets are assuming that this boom will continue for years, while credit markets are increasingly concerned about sustainability and malinvestment and demanding a higher premiums to finance the boom. The boom is built on expectations of enormous future AI revenues to justify all this infrastructure, but actual tokens prices are declining, and there's growing use of cheap Chinese models. So I don't see how all this investment will pay its way, will earn an economic return. And
No,
if so, we're just waiting for the bubble to burst. I
yeah,
mean, AI, so NVIDIA's incentives are absolutely to keep on subsidizing, like lending to its customers so they can buy NVIDIA chips. But at some stage, that circular game becomes unsustainable. Richard.
well, completely, Keith. What can I say? I completely agree with you, and it's been heading this way for quite a few months, and it's just continuing. And at
Yeah.
some point, it will cease to continue.
Yeah, but that chart of like future AI commitment, infrastructure commitments,
Yeah,
is absolutely shocking.
yeah.
Now, let's take a look at one of these data centers. Okay, so NVIDIA is in negotiations to provide a $250 billion guarantee for the Port Technology 10 gigawatt data center. What is it? What will it do? What will it cost? Okay, so it's built on Department of Energy land that used to house a uranium enrichment facility. Okay, so I suspect the Department of Energy have been struggling to find tenants. It will have a capacity of 10 gigawatts, of which 9.2 gigawatts will be provided by an on-site natural gas power plant. Okay, so this is how AI infrastructure spending will lead to higher gas demand. Okay, that's an enormous amount of gas, by the way. And the local utility will provide 4.2 billion in grid investment to upgrade transmission lines. The total cost is expected to be 500 billion. So, 1.5% of US GDP for this one data center alone. So NVIDIA would be guaranteeing half of it. Construction has begun on phase one, which will be 800 megawatts, and it's due to come online in 2029. So construction already providing, medium-term boost to the US economy. But when you look at the numbers involved, they're absolutely mind-blowing. So currently, the operating capacity of all online data centers in the US is approximately 17 to 20 gigawatts. This one data center would be 10. So like half of the total current data centers. And the internet and AI seems to work just fine as it is. The average home in Ohio, this is being built in Ohio, consumes 846 kilowatt hours per month. So this data center would consume the power equivalent of 8.5 million Ohio homes. The largest existing power plant in Ohio generates 1.8 gigawatts, and so the 9.2 gigawatt gas generation plant would be 5 of the largest power plants in Ohio. Astonishing. And currently, that's not the only one in Ohio. Currently, Ohio has 65 data centers with an operating capacity of 3.6 megawatts. 3.6 gigawatts. A further 119 are planned with a capacity of 20.8 gigawatts. So if all of them were built, then capacity would rise by 6.8 times to 24.4 gigawatts. And that would consume the equivalent of 20.7 million Ohio homes. These numbers are absolutely staggering. So where's the money coming from? Well, we've shown you this chart before. This is the Hyperscaler's free cash flow, the Mag 7's free cash flow, which has gone deeply negative. So that means they've been turning to debt markets. Now, FT Alphaville had a piece during the week looking at how much leverage the hyperscalers actually have. Now, they report leverage of a relative lowly 0.5 times, and that is not a worry because they currently have more cash than debt. But when you look at their off-balance sheet financing, then that rises to a more concerning 1.3 times, although frankly, that is still below the average of all US industries.
Yeah, I think the point here, Keith, is that all of these industries, if you exclude information technology and hyperscalers, they're all established industries with cash flows that are able to support the debt. But this is debt that is being spent in the hope of a future cash flow.
Yes.
And so it is functionally different to, so what they're comparing it to is functionally different to what they're doing. And that's the danger of saying, oh, it's quite low debt, quite low leverage, because actually they have yet to generate the return to cover the leverage.
Yeah, and also I'd say the earnings numbers are being flattered by all this spending.
Yeah.
So, those leverage numbers, they're not the long-term average leverage. They are being flattered by cyclically high earnings. So, to give you an example of how big these things are, this is the Meta's proposed Hyperion data center in Louisiana, superimposed on the island of Manhattan in New York. It's just the scale of these things is mind-blowing.
Yeah. I mean, the point really here, Keith, is that there's far too much excessive development, and at some point it'll settle. The excess will be written down, and businesses will go bankrupt as a consequence. And they're currently in this huge race to be first over the line. But it doesn't necessarily mean first over the line is one who wins the race, because it's much more complicated than that.
Well, this will continue as long as equity markets reward this spending.
Yeah, so they've all lost the plot collectively, but it's not going to change until they start going bust.
Yeah, I agree. So let's talk about the funding for this data center, which will be built in Louisiana. So it is a Meta data center, and so Meta and the private credit company Blue Owl have formed a joint venture, Beignet LLC, which has issued 27.3 billion in debt in the largest single bond offering in history. Now, Meta only owns 20% of Beignet LLC, and therefore headline number is it's only online, only has to put 20% of that debt on its books. Various funds linked to Blue Owl own the remainder. So Beignet owns a company called Laidlaw, which will own the completed data center. But Beignet has guaranteed future revenues from Meta, who have contracted to use the data center for 20 years, starting in June 2029. Therefore, essentially, Meta has guaranteed the whole of this debt, plus more, because revenues will be much higher. And it's the revenues from Meta which have backed the 27.3 billion in debt issuance. The Beignet 6.58% bond was the single largest bond issuance in history. Okay, so this is the structure of Beignet LLC. If you're interested, pause and have a look. But, it will take you a while to work out how all the funds flow. Meta's up here. It has contracted with Pelican Leap to, anyway, work it out. But basically, Meta has contracted to buy all the capacity from the completed data center for 20 years, and everything else works off that. But it's only had to put 20% of the debt and none of those future leases on books. So this is the price of the Beignet bond, and actually initially it rose well above par, but then it's been drifting off and is now around par. So the point of all this is the hyperscalers have massive hidden financial commitments. According to Goldman Sachs, the hyperscalers have aggregate future lease commitments of 1.5 trillion, of which 1 trillion has yet to commence and therefore does not have to appear on their accounts. Under generally accepted accounting principle rules, uncommenced leases are not shown in financial accounts. So none of this has yet had to be declared. In addition, there's an aggregate of almost 1 trillion in purchase commitments for equipment, etc., across Google, Alphabet, Microsoft, Meta, Amazon, Nvidia, and Oracle at the end of Q1. So the hyperscalers have massive financial commitments, much of which is not showing up in their accounts. And at some stage, all of this needs to demonstrate you can earn an economic return. And given the scale of these investments, the amount that will have to, in revenues, they'll have to be taking in is just astonishingly large. Right now, we're in the build it and they will come phase of the bubble, but it's not clear to me. In fact, I just can't see how they're going to earn a return on this, because as we've seen from the section earlier, customers are just not willing to spend infinite amounts on AI. They'll use a cheap Chinese model instead. And onto commodities. So starting with energy commodities and the resumption of the war in Iran has meant the Brent rose actually by not much. This is before the markets opened this morning. And Brent was up to 87.8, up 5.1%, up 44% on the year. WTI up 2.8%. Natural gas futures in Europe, unfortunately, continuing to rise. Market becoming worried that Europe will not have time to refill its storage tanks before winter comes. So up further 8.4%, up 115% on the year. Sadly, UK natural gas prices also rising, up 3.5%. US natural gas prices going nowhere. So US natural gas prices, $2.76 per BTU. The UK equivalent is approaching $20 per BTU. So there's a big arbitrage opportunity, and that is why you are getting massive LNG liquefaction commitments in the US. Meanwhile, coal going nowhere, still up 20% on the year. Uranium drifting up, but only up 7% on the year. Some charts. So this is Brent. Straits are likely to remain closed for longer, but oil price nowhere near where they were at the start of the war. So staying long, frankly. I see no prospect of them opening anytime soon. This is WTI, but the oil market has coped incredibly well with the disruption. Okay, so we've had the global oil inventory numbers from the EIA for July. And once again, they've revised upwards their estimates for global oil inventories. So this is what we were reporting last month. They were saying the end of June, there was 2.6 billion barrels. They're now saying actually in June there are 2.644 billion barrels. So as a result, their estimate for global oil inventories at the end of July has risen. Now, obviously, July was when we had the ceasefire and oil escaping from the Gulf, but inventories have not been falling as fast as we would have expected. And so, the past couple of weeks, the US has reported a net build of almost 9 million barrels. Meanwhile, US oil production is stable towards its highs and unchanged on the year. The Baker Hughes rig count continues to rise. Now, so this is a series of charts of US oil inventories. And look at oil exports, which is the circled chart. They surged, but now they're falling again. And so part of the reason oil inventories have been rising, oil inventories top left, is that oil exports have been falling. You'll notice, though, that refined products, so that's gasoline and distillates, are not rising. But if we look at the world as a whole, then inventories, global inventories continue to fall. And this is the EIA's forecast for US oil production in the coming 18 months, and they're saying that it will keep on rising. So seeing no peak in US oil production. Indeed, so the EIA releases various different forecasts. The Drilling Productivity Report is forecasting that shale oil will surge over the coming year. Now, it's not clear why they think that. Presumably, it's because they think that higher oil prices will get a lot more rigs into production. Meanwhile, higher oil prices have been very good for the majors. Hurrah. This is EU natural gas futures. That is bad for EU industry and EU inflation. UK showing a similar pattern. US natural gas futures, US supply growing, prices going nowhere. Yeah, this morning actually, EIA was reporting that production was 4% up over the course of H1. Just the US gas production just keeps on rising. Coal going nowhere. Uranium drifting slowly up. Onto industrial metals, Richard.
Thanks, Keith. So aluminium was up 1.5% on the week, cobalt unchanged, and copper very little change. Copper was up 16% on the year. Iron ore down 3%, down on the year by 11%. Lithium up 8% on the week and 28% for the year. Neodymium down 3%, but still up 27% for the year. Nickel pretty much actually unchanged, really. Tin 1.5% in the week and 37% up for the year, and zinc 1.8 for the week, 20% for the year. So some significant rises over the 12-month course, suggesting that the demand, the view of the market is that demand is building.
Yeah. So commodities generally doing well.
Yeah, there's aluminium, cobalt, copper.
Yeah, that chart looks bull market firmly intact. Mm-hmm. And frankly, the more I read about copper, we've done a special on this, obviously. I just can't see how we're going to provide enough copper to meet demand. So what's happened over the past couple of weeks is Congo has banned copper and cobalt concentrate exports. Actually, that will have less effect than you might expect because they'd already, put in measures to try and get as much processing done domestically as possible, and so not that much effect. But medium term, black line demand forecasts, blue line supply forecasts.
Mm.
I just can't see how you're going to fill that. Copper to the moon.
There's iron ore, lithium.
So it's had a bit of a bounce, but downtrend still intact as yet.
Yeah, so neodymium and nickel, tin, zinc, some precious metals. So gold and silver have had a good turnaround from their lows, and up 6.5% for gold, 10% for silver. Silver's still down 10% on the year, but gold is flat. Platinum up 3.5%, rhodium up 7%, and palladium up 1.2%. All of those three down on the year, though. So the question is, have the precious metals bottomed?
Yes. SimonW's technical analysis will be coming up.
There's gold. Total. So people have been going back into the gold ETF.
Yep.
And China has continued to buy gold. Gold miners' free cash flow per share is doing extremely well. So gold miners are very profitable businesses at the moment.
Yep. So this is your point, Richard, about monetary debasement. So everyone thinks gold's going up, but actually what's really happening is that fiat currencies are declining relative to
Going
gold.
down. Yeah.
We continue to print loads of money. Yeah. Print loads of money. Nobody's printing gold.
Yeah. Silver, platinum, rhodium, palladium.
Thank you, Richard. Right, on to rates. So from next year, actually, I'll put a table in for rates. But here we are, the UK yield curve towards its highs. Basically, rising oil prices, bad for inflation and bad for bond yields. So, and also we have got new government and we're waiting to see how fiscally irresponsible Andy Burnham will be. I don't expect any answer to that before the autumn budget. So staying out of bonds until that time. US yield curve looks absolutely terrible, frankly. Keeps continuing to rise. All the yields above, what's that, 15 years are now above 5%. 10 years still rising. And that is despite the fact that economists expect core inflation to keep on falling. And recent inflation reports in the US have been benign, frankly. So this is a UK 2-year, going nowhere. Still massively up from pre-war. UK 10-year towards its highs, not coming down. Difficult to see these coming down until the uncertainty over oil prices and therefore inflation is removed. UK 30-year looks bloody awful, 5.7%. If we look at the TG61 UK long-dated, i.e. 35-year conventional gilt, it has a gross yield of 5.5% and a net yield of 5.2%. So you would get that 5.2% tax-free. Okay. Now, if we assume that UK inflation settles about 2.5%, you're getting what? 2.7% real? It's absolutely amazing. But frankly, it ain't going anywhere currently. And until we get some certainty over the end of the war in Iran and over Andy Burnham's fiscal rectitude, it's difficult to see it as a buy. But, compounding at 2.7% real, that's very, and after tax, very difficult to beat. This is UK, US 10-year rising, US 30-year rising. Now, coming up, we have charts on the US fiscal deficit getting worse. Is the market finally becoming seriously concerned about the US fiscal solvency? At some stage, the US might have to change tack and actually start raising tax rates. This is German 10-year, stable towards its highs. France, same. Italy, same. Japan, bond yields rising again? Question mark. Okay, and on to current investment themes. Not much change, but bull market, is that back on? You know, last time we checked, it was having a wobble. Kospi was imploding. Well, stabilized, and the S&P 500 is now back to new all-time highs. But IPOs are going to start draining liquidity in the second half of the year. Disruption of the war in Iran, well, the market just seems to think that's totally manageable. VIX is astonishingly low. So the bottom line is the market just thinks that any disruption from the war in Iran is manageable.
Okay, so SimonW's technical analysis. This is the NASDAQ. So obviously we've had a strong run from about 400 to 700 over the period of this chart, which is 2 and a bit years. So is a recent sell-off a start of a reversal and a significant fall, or is it just a sell-off that is going to result in the continuation of the trend? And the answer is he doesn't know. He wants to wait and see what's going on.
Yeah, the thing is, when you look at this, we've had various, sell-offs, and then it's bounced back and continued wildly higher. But technical analysis, you're waiting for the trend to establish itself, and I don't know.
I mean, you could say that the trend hasn't actually broken, has it? Because and it's just a reversal within the trend.
Yeah.
So far. So Philadelphia Semiconductor Index is obviously done extremely well. And it went up threefold in that in basically in about a 14-month period. It's obviously now come off that high. So again, is this a is it going to be a continuation of the trend? It is it's a flag in the right direction, isn't it? So is it going to continue the trend upwards, or has it broken down?
Yeah, well, Simon thinks further weakness is likely. I mean, to me, this really just looks like a blow off top. Yeah.
So what he's doing here is he's combining technical analysis with a view of what's going on in the economy. So
yeah, that's true.
And in fact, so it's with the potential weakness caused by Chinese competition.
Yeah.
Inconclusive.
But I do like, when you look at these trend lines, the purple trend line would seem to be, mind you, it's crossed back there, but it's coming down. Wait until they cross again is the advice for technical analysis.
Yeah, all the moving averages.
Yeah.
But neither you or I are going to invest in any of these, Keith. So
no, we're not. That's true. But then we haven't made anywhere near as much money as Simon has. So, that's like yeah.
So this is Micron. It's the same chart really as the semiconductors, and the same question.
Yeah. So basically, just wait. Essentially.
Alphabet, a very similar chart again.
Yeah. Approaching key resistance levels. Wait to see whether it breaches them on the downside or bounces back up.
Yeah. And Microsoft, which, as we spoke about earlier, has had a good earnings report and bounced by 20%. Yeah. You wouldn't have projected that from a technical analysis, would you?
That's true. But, That's true, but it's news obviously disrupts everything.
Yeah. Marathon, which is a oil refining company. As Keith mentioned earlier, oil refining margins have gone up very dramatically. And so the oil refiners are benefiting significantly from what's going on in the Persian Gulf and the actions of Donald
Yeah,
Trump.
absolutely. So the reality is, the longer this goes on, the more they're making extraordinary profits. But the moment there is a deal and the straits reopen, kaboom, these goes back
Their
to
profits revert,
profits start
presumably.
reverting. Yeah,
Yeah. Well, of course, that assumes that the market ever gets back to where it was in
that's
terms of
true.
supply, and does it actually get sorted out? Because see, currently it's getting worse, isn't it? Libya, um, the attacks
Yemen,
on the Russian
yeah.
refineries. Um,
We still don't know who sent those two drones to attack the LNG carriers in Egypt.
no, we don't, do we?
No, it's
So
not getting better.
exactly, exactly. Silver.
Yeah,
Is it likely to drop below $49 again? I suspect it's not going to, actually.
right.
I suspect that it's going to resume its uptrend, not as a consequence of charting, but as a consequence of macroeconomic factors, and not as a consequence of looking at charts, but which I don't really do for these because I find them misleading. But as a consequence of macroeconomic factors, I may be wrong, but I suspect that it has
Mm.
reached its bottom now, and that it's not going to go below $49.
Okay, well, you have a long-term fundamental view, Richard.
Yeah.
To me, this looks like so many silver charts we've seen over the years. Hunt Brothers, late 1970s,
Mm.
where you have this enormous spike up, and then essentially you have an oscillating down trend for
Yeah.
years afterwards until
Yeah.
regain stability, and that sort of is what
Yeah.
Simon is predicting. And
And it
from
hasn't it
fundamentally,
hasn't
he's
broken
right.
out of that oscillating downtrend yet. So
Yeah, that's
um,
true.
he's right in that sense. Gold um, hasn't broken its recent downtrend. You can actually, well, you can draw it differently. You can draw anyway, doesn't matter. Is it? I mean, I think for the same reasons, the gold has probably bottomed at 3,900,
Right.
and it's going to go up. And
Yeah.
So again, it's macroeconomics, and obviously I haven't sold anything, so I'm just sitting here
Yeah.
waiting. But my sense is that it has now bottomed. But
Okay. Well, Simon's view is that wait and see, basically.
mm,
It's still in this channel.
yeah,
So is it just going to grind higher or is it going to go through the earlier support lines? Need
yeah,
to wait for the trend to resolve itself.
yeah. Copper is has broken out of its channel.
Hmm.
It hasn't retested the break. Well, retested the breakout in sort of March or so, and then it's continued to go higher. There is a structural deficit of copper, but there's also a lot going on in the US market with tariffs and not tariffs, and people not understanding where tariffs are,
Yeah.
and hoarding and stockpiling. So it's difficult to really know what the true position now currently is, but obviously in the future there is a significantly large structural deficit forecast. So again, for me, it's a long-term hold. I wouldn't buy it at this point. Looking at this chart, it looks like it's probably due for a bit of a retracement, personally. But
Well, the thing is, Richard, this is where you and I, who are like innately have this value bias.
yeah,
This is where we've got, massively underperformed relative to Simon, who doesn't care. And like
yeah,
to Simon would be saying, this is going up. Look at those trend lines. It's
yeah.
like just like Nvidia, etc. And this looks good. Now, I've also asked Simon to give us some charts of copper companies he likes. So
Mm-hmm.
this is Southern Copper, and it's in this kind of holding pattern at the moment. What's been very noticeable, I don't know whether you have a view on this, Richard, but copper companies have not been doing as well as physical copper. The copper prices kept on going up, but
Yeah.
copper companies actually have been going nowhere for the last 6 months.
Yeah, I mean, I think a few of them have done reasonably well, but a lot of them haven't done anything very significant. And I agree with you; they haven't reflected the increase in price. I mean, presumably they will. Maybe it's because people, potential investors, are waiting to see whether they do benefit from the increase in price in earnings and so forth.
Yeah.
I think there's a little bit of concern about the cost of diesel fuel as well, impacting
Yes,
that
of
quite
course.
closely.
Yeah. So Simon's saying basically it needs to decisively break up higher for the uptrend to re-establish itself. It's currently in a
Mm.
holding pattern. A lot of these are similar actually, but Euro has massively shot up in the last few days, but it's not broken to new highs.
No, but give it time. I mean, it's done. What is it? It's doubled, hasn't it, from
Yeah,
its sort of low in 2025.
yeah,
Um, I think it's. I mean, I suspect that Hero is actually going to do really well,
right,
personally. But
yeah. Well, I'm waiting for the inevitable AI bust, and then I'll buy it all. But not until then. And that's why I haven't made any money in the last few years because I haven't just piled in. Um,
Capstone Copper,
gone,
I've never heard of Capstone Copper. Uh, so it's still got the same chart pattern, hasn't it? It went up earlier, in January in 2025. It's been marking time now in 2026.
yeah. And onto one chart. So I thought this is really interesting. This is the Dow Jones
Mm,
in the lead up to and actually the outbreak of World War II.
mm.
And so what it shows is that markets hate uncertainty, but they don't necessarily hate war.
Of course, I don't know what happened when the US actually entered the war after Pearl Harbor.
Yeah.
What did
It's
happen to the stock market then? Because the US it was like there was a war on the other side of the world.
Yeah, that's true. Of which, the US was going to benefit from huge industrial orders.
Yeah,
But certainly the stock market did okay over the course of the war. You just
it'd be
think
more
about
interesting. Yeah,
the fiscal deficit went through the moon, you
it'd be
know.
more interesting to see what the European stock markets did in this period of time. More relevant, one would have thought.
That's true,
If I
actually.
may, if I may comment, John.
Yeah, no, that is true. But you'll see that uncertainty, Anschluss, Czechoslovakia annexed,
Yeah,
bad.
but I mean, who in America really cared about this? Seriously,
Well,
who
yeah,
actually knew what was going on?
but the point is, Richard, fears over war caused the market to go down. But when the war was actually declared, the market went up.
Hmm, not convinced, Keith. Sorry.
Really? Okay. Right. Quiz of
Interesting.
the week.
Okay, David and Ina Steiner.
Do you know this? So,
55.7. I
yeah,
no, I,
this wasn't just a refund of some, dodgy socks they'd bought. So, gone, why did a judge in the US order eBay to pay this couple 55.7 million?
because eBay was selling knockoffs of something they produce. That would be
No,
my only guess.
no, this is a really bad and sinister story. Okay. So the Steiners ran an e-commerce blog called E-commerce Bytes, um, which gained a lot of traction, was very popular a few years ago, and they became very critical of eBay over its pricing structure.
God, it's appalling, Keith.
Yeah, and in 2019, the CEO of eBay, Devin Weinig,
Is he one of the ones who went to prison?
he didn't know. He said he predictably uh, Richard said that it had all happened behind his back and he didn't know anything about it. So,
Well, on the basis of I don't want a pig's head mask arriving in the post, I'm sure he's telling the truth, Keith.
yeah, yeah, obviously. So, yeah, basically, eBay then mounted a campaign of harassment against this couple, including threatening messages, box of live cockroaches sent to their house, bloody pig's head masks, funeral wreaths, a book on surviving spousal bereavement, delivered to their house. And what I thought was quite creative was they subscribed to various pornographic magazines in David Steiner's name and then had them sent to neighbours. So in 2023, so the police got involved. They discovered it was eBay, and 7 employees were jailed for between 1 and 5 years. Obviously, eBay, you know, denies that the senior management had any knowledge of this, and they've now finally come to a settlement with the Steiners. But this is an outcome of capitalism. This is like capitalism. If you're just aiming to optimize your profits, then yeah, harassing the Steiners is
all part of the deal. It's
all
just
part
it's
of the deal.
business as usual.
Yeah, this is why you need a legal context, but still, astonishingly bad behavior by eBay.
Yeah.
Okay, and on to China's property market. Richard.
Thank you, Keith. We've discussed China's property market at length a couple of years ago, really, with when it started to decline really dramatically, and various Chinese property developers went bust in a massive way. But what's actually continuing to happen is that property prices are steadily falling.
Yeah.
Now down 25% from their peak and showing no signs of stopping.
Yes. And when we started the podcast, we were very, talking about all these ghost cities. Was it Ordos?
Yeah.
Etc. And those fears were absolutely justified.
Yeah. So price falls have been bigger in the second and third tier cities than in the major cities. And so you can see that basically there is a consistency throughout China of Chinese cities of price falls. So
yeah, and it's ongoing. It ain't bottomed yet.
The real estate property bubble was enormous, and it's fallen as a percentage of GDP actually quite significantly because, of course, Chinese GDP has been growing. It's fallen from 10% to 5 and a bit percent.
But it's still high.
It is. I don't know what is an international norm. Do you know?
I'm honestly, I don't know.
It's interesting to know where they lie in that. But
this area above the chart here, that is all excess investment.
Yeah. And the disproportionate amount of Chinese wealth is held in property, which means that, of course, Chinese individuals have been feeling much less wealthy than they were because they've lost a lot of money.
Precisely.
And feeling the pinch. So Japan had a 20-year-long balance sheet recession. The Nikkei dropped from something like 30 over 20 years. It fell from like 35,000, did it, down to 10,000 or something over that period of time. So if you look at Japan, Japan had a big balance sheet recession and a huge property bubble in the early 1990s, and at 6%. China's now got below 6%, and the Chinese economy is still doing very well, we believe. So China seems to have avoided the balance sheet recession, but obviously it's got a residential property recession. And that may be the difference, that Japanese companies were hugely invested in property and hugely indebted, whereas Chinese companies aren't.
That's a very good point, Richard. That is a very good point.
So in Japan, it resulted in a balance sheet recession and a lot of economic damage, 20 years to get over it. In China, that may not be the case.
But previously, property development was a key driver of the Chinese economy. Now, it ain't going to be going forwards.
No, it's not. And Chinese GDP has fallen back from its steady 5% year-on-year growth, hasn't it, I believe?
But, we don't know the numbers, but, there was this dissident economist who said that actually Chinese growth was probably around 2%.
Yeah, so it has suffered as a consequence of it. And it would be hard to believe that it hadn't. But it's still growing, and the economy still appears to be quite vibrant and quite resilient.
It does, but property market is going down. We know that Chinese individuals have huge investments in property, which they've funded actually largely through cash, but also through mortgages. So their balance sheets are declining.
Mm.
So the wealth effect will be negative. And the Chinese consumption sector is already weak. And so, it's dominated by industrial policy.
Yeah.
So essentially, in order for the Chinese economy to keep on growing, when you've got a structurally weak and weakening, probably, and what we're saying is going to be weakening
Mm.
consumer sector, it's going to go yet further into
Export markets.
export markets.
Yeah. So that's what it's doing, isn't it? I mean, it is aggressively trying to take out manufacturing industry across the world.
Precisely. It's just
And
like, yeah, every single sector it's trying to dominate.
yeah, and it does it quite effectively as well. So I mean, I agree. All of those on the previous slide, all of those risks are risks. It is, as you say, Keith. It's doing what it can do well, which is manufacturing,
Mm.
and it is presumably trying to bail out quietly, sub judice, the banking sector from the property loans.
Well, one of the things that we kind of haven't really discussed is the fact that, you know, the Chinese massive exports are facilitated by fixing the currency.
Mm.
Because, when you run a
Yeah,
trade surplus of this amount, I
yeah,
mean, the trade surplus shouldn't naturally tend towards zero i- as the currency appreciates. But by
yeah,
keeping the yuan low, they facilitate this enormous export boom and current account surplus.
yeah. So new Chinese car registration in Western Europe um, have more than doubled in the last two couple of years.
Yeah. So it's just, taking over new industries.
Yeah, and causing serious damage to the likes of BMW and Porsche
Yeah.
and Audi. So the previously main engine of Chinese economic growth, being the property market, stalled, uh, and China is directing state investment away from property. But of course, all of its exports come with other countries, the importing countries, seeing their industry being seriously damaged, and so tariffs and fighting back against that. So it's very difficult to know what the final outcome is going to be. I mean, Europe is now very, very strenuously fighting back over Chinese domination of its industry, rightly
Mm.
so. And at some point, I guess an equilibrium is going to have to form. So it's a dangerous situation for the world, I think, because obviously China's
Yeah.
fight, isn't it, to not have serious economic damage. But it is a very resilient country, and they have shown themselves to be, I would say they've shown themselves to be very clever over the last 10 to 15 years.
They have, but this is the advantage of having a state-directed economy.
Yeah,
Yeah, they're less concerned about short-term profits,
yeah,
more about the long-term outlook for the country. But there
yeah.
also is not at all clear that these export booms, these export industries are actually profitable.
The other thing I would comment on is that first graph that you showed, Keith, of the decline in residential property value over the last few years. It's a remarkably straight line, and in let's say the UK, you would tend to get it would fall off a cliff, and then it would
Yes.
stabilize and so forth. It looks very much as if it's being managed in some way.
Um, oh, thank you, Richard. Now, more on AI. Okay. So, did you know that back in 1884, when aluminium was first produced as a metal, it was more valuable than gold? It
I
was a
did not.
symbol of wealth. They used it to cap the Washington Monument. Napoleon III served his best guests on aluminium plates. Everyone else just got gold. And at that price, aluminium had no industrial uses.
It's a very nice analogy, Keith.
Yeah, absolutely. And so, but then, when they built a hydro plant in Niagara Falls, aluminium became available, and now you use it to wrap sandwiches. So,
Mm.
AI will be
It's a
used.
commodity. AI is a
Exactly.
commodity.
Yeah, precisely. And this is the chart we keep on showing. So basically, to get marginal increases in ability, you have to spend exponentially larger amounts on the most cutting edge models. And I thought this was a fantastic chart. Basically, this is the ability of the various different models over time. And what you can see is the Chinese models basically followed the most cutting edge US models with a lag,
Mm.
6 month lag. And they're now more capable than US models were 6 months ago, and they're free. So why pay up for the latest model? You can just wait a bit,
Mm.
and the Chinese model will catch up. So when you look at intelligence versus cost, all of our best models are Chinese. Meanwhile, actually, when you ask who's going to pay for this, well, you have a few intensive AI users who are paying lots for AI, and like most people paying bugger all. You and I are paying zero.
Extraordinary, Keith. And even the top 10%, at 600 versus the median at 11%. It's you can't spend this much money on that business model, can you? We can, but it's not going to have a happy outcome.
Yeah.
Is the obvious conclusion.
Um, but the hyperscalers, these are their revenue expectations, or what they're needed to meet to justify all the AI investment. Absolutely enormous revenues
But it's not going to
required.
happen, is it?
It's just, actual revenue required.
Yeah, I
You
mean,
know,
it's just not going to happen, Keith.
it's just not going to happen. It's insane. But, we showed you various charts earlier. Everyone just seems to be increasing their investment.
Well, the idea is, I mean, basically, it's the sunk cost fallacy, isn't it? As in,
Yeah.
it doesn't matter how much we've spent on it, we can't get out of it. We've got to
Yes.
outcompete everybody else, and we'll be the last man standing. And
Yeah.
to be the last man standing, everybody else goes bankrupt, but actually, then you probably go bankrupt too, because you'll never be able. If you spend that much money, you'll never be able to recoup it.
Yeah. So, I mean, this is an example of previous, build it and hope. So in 1998, Iridium proposed to create a satellite network that enabled mobile phone calls anywhere in the world. It spent 5 billion, of which 2 billion was debt. And as it built the network, its share price soared. Meanwhile, when it actually finished the network and went looking around for customers, there weren't any. Share price collapsed. It was later bought by a former airline executive for 25 million. So
Big
there you
discount.
go. We're just deeply, deeply skeptical, frankly. I just don't see how anyone's going to pay for this stuff.
No.
And while we're talking about AI, this is really short and interesting. So AI has a scaling problem. Okay, so what reason like tech companies do very well is that as you increase the number of users, your the cost of fulfilling the each user's demand falls. Okay, so your marginal cost falls. That's the whole bull case for tech. This is why tech companies do so well. For large language models, that is not the case. Okay, so on the y-axis, you have the cost per million tokens generated of various different AI models. On the x-axis, you have the tokens per second per request. Okay, so the more tokens, your input tokens per second, the more you get an exponential increase in the cost for your output tokens. So the more complex your input request, the more exponentially expensive your output tokens. So when these AI companies are charging per output token, their costs are not fixed. Their costs depend enormously on
Mm.
how complex the instruction is and how much computing they need to do to output an answer.
So what they need, Keith, is they need a little AI model at the start that assesses how much it's going to cost and then says, this is going to cost you X dollars. Are you prepared to
Yes,
pay? Yes or no?
precisely.
That's what they
Yeah,
have to do. And everyone will say no. Most people will say no.
exactly. Yeah, exactly. That's exactly what they need. If you look at these number of tokens processed, and then you combine it with the previous chart, what's happened to OpenAI's costs, etc. So currently, you know, yeah, everyone's talking about their revenues going up, but what have their costs done? So bottom line is this whole the pricing model, everything just looks insane.
So looking at the OBR Fiscal Risks and Sustainability Report for July of 2026, obviously this is a UK report. So we have an aging population, which suggests there will be falling tax revenues in the long term, plus increased social care, pension, and healthcare spending. So this is a projection. On the left chart, we have population share by age.
Yeah.
So
Going to have an increased share of very elderly people by
yeah,
2075.
I mean, basically, it's the sort of 760 to 95 range, isn't it? Where and with a tipping point at around about the age of 50. Anyway, so
Yeah, but it's slightly worse than that, Richard, because also we're going to have far fewer
fewer young people.
of their,
Yeah,
peak earnings.
yeah. And the primary receipts and spending by age is uh, gosh, these charts aren't easy to interpret, are they? I have to say.
Mm.
So if you pick, let's say, 40 to 40, the age band 40 to 49, then primary receipts and spending there is tax revenue is plus 30.
Yeah.
And other spending is the majority of the spending. If you take the age bracket 70 to 79, then tax revenue is only 10, i.e. 1/3. And there's a massive increase in welfare and health.
Yes.
And actually other spending looks like it has dropped a little bit.
Yeah.
No, so which is the essence of the problem, isn't it? It's not only does the tax contribution rise, but the cost of providing health and welfare care goes up very rapidly over the age of about 60.
Yeah. So in essence, by 2075, we're going to have fewer people in their peak earnings period which they contribute to the state,
Yeah,
and loads of people, old people, who are net beneficiaries of the state.
yeah, which is a problem. So we know that the triple lock is totally unaffordable. I mean, if Cameron had any mathematical ability at all, he would have been able to work out for himself that it was completely unaffordable. No prime minister's got the guts to get rid of it. Every prime minister from Cameron onwards should have got rid of it. And it has to be got rid of, and it has to be done fairly soon. It's just bonkers.
Yeah. But I mean, it's classic politicians' behaviour.
It's just, but it's grossly irresponsible. I mean, Angela Rayner wants rent controls. That's fine. I think she's completely misguided and wrong. But it's like, okay, well, from her point of view, it's legitimate. This is from no point of view is this legitimate. From no point of view.
Yeah. So, but basically, you could we massively improved Britain's long-term fiscal sustainability by just uprating it in line with CPI.
Mm. Well, unless something's done, yes, the public sector debt will explode because we are on an unsustainable path. Does Anti-Burnham watch Portfolio Matters, Keith?
I doubt it very much. Essentially, our welfare spending at these levels is totally unsustainable. Full stop. That's it.
Yeah. At least the OBR is pointing it out. I mean, they'll always leave it to the next government. It's a bit like Gordon Brown, isn't it? He invested vast amounts of money, incredibly high interest rates, in building health facilities, and so that the future generations could pay off the debt. And he didn't care because politically it was opportunistic, but actually for the country it was incredibly bad.
Yeah. This is just I mean, just please pause and just contemplate this chart for a second.
Yeah,
Just
well,
even under,
it can't happen, can it, Keith? But
no.
what has to happen to stop it from happening? Goodness knows.
Yeah.
And the OBR's baseline scenario is that unless something changes, government will need to raise tax revenues by 3.8% of GDP to stabilise the tax burden. Yeah, and of course that's always the case, isn't it? Oh, we just need to raise it by another 2%, And
Yeah.
do you remember? I remember when Charles Kennedy, God rest his soul, he would say all we need is 1% increase in tax, and the NHS will be sorted out. And I think that was when the UK tax servicing total was about 35%.
Yeah.
And we've had umpteen percent increases in it. And of course, it's not sorted out because nothing's ever as simple as that. And actually, the way to sort it out is to manage it properly. And politicians typically can't manage their way out of paper bags.
Yeah. Well, entitlement expectations just keep on rising.
Yeah. Although apparently Andy Burnham actually is apparently Keir Starmer basically wanted results. He didn't want problems. He wanted solutions. So he didn't engage in the problem. And then he didn't like the solution. He said, "Go back and fix it." And so that was a very bad way of managing people, very demotivating. Apparently, Bandy Burnham is much more interested in being part of the solution, part of solving the problem, which I think is a positive sign.
The thing is, the OBR is not making any assumptions. Its adjustments are all increased taxes.
Yeah,
they're not cutting entitlements or dealing with the NHS. The NHS is a bottomless pit, basically.
Yeah. I mean, it doesn't actually come up with anything useful, does it? What it says is you can't do this. It's a real problem. But actually, it needs to, maybe it does in the detailed report, it needs to come up with relevant, appropriate ways of cutting expenditure.
Yeah.
Is that the role of the National Audit Office, or is that the role of the Treasury? I mean, goodness only knows. We've got so many So aging population means the status quo is unaffordable. So we have to raise productivity. Yeah, right. That's not going to happen, is it? Because we aren't making the capital investment necessary to do that. Cut government expenditure on healthcare and benefits because they're the most expensive, apart from our interest, of course. Raise taxes or go bankrupt.
Yeah. Cheery stuff, huh? Now, so previously, obviously I was bought gilts and got absolutely stuffed. And the danger is the long-term, the long-term investment case for gilts is that yields are high and UK government won't go bust. They'll always pay away. But when you look at that, the adjustment we would need in order for the gilts to be a good investment, you would need a government that is capable of dealing with UK's long-term fiscal problems.
Yeah. So there's a significant default premium in them, isn't there, at the moment?
Yeah.
So, very depressing.
Right. On that cheery note, we'll let Richard go, and I will now go through all the macroeconomic data.
Thank you very much, Keith. See you next time.
Before we get going, a quick summary. I've actually revised my opinion because UK GDP has unexpectedly strengthened. Actually, whereas previously I was saying stagnation, actually 1.2% growth is essentially on trend, boosted by the information technology sector. So actually the UK economy is growing in line with its long-term average. Inflation is 2.6% in June, so sort of trend growth currently. Obviously, if the war in Iran causes oil prices to keep going, we could have, higher inflation. But right now, UK economy doing okay. EU the same. So GDP growth was 1.9% in Q2. Inflation at 2.9% in June. So more, inflation in the EU. But actually, again, the EU economy does not have strong trend growth potential, so it's doing okay. The UK and European economies have proved more resilient than expected. US continues to do absolutely fine. There is no sign of secondary inflation pressures anywhere. Economies appear to be doing fine, growing at or above trend everywhere, boosted by AI infrastructure spending, which we obviously believe is unsustainable medium or long term, but right now, doing okay. So on to the UK. We had Q2 GDP numbers quarter on quarter 0.4%, better than, so in line with expectations. Year on year, though, better than expectations at 1.2%. The NIESR estimates UK's trend long-term growth potential is 1.25%, i.e., is growing in line with potential. And when you break down GDP growth, most of it is from services. In fact, pretty much all of it is from services. And then within the service sector, the biggest contribution was information on communication, i.e., the UK is benefiting from the AI boom. Month-on-month numbers, June 0.3%, which is a good number actually, 1.1% year on year. Looks good. Business investment, this quarter on quarter chart, 1.7% quarter on quarter, 0.8% year on year. A lot of that IT. Industrial production, though, not great. Minus 0.2% year on year. Higher gas prices not helping UK industry. UK construction output struggling, down 2.3% year on year. Construction sector hit by higher interest rates and higher costs. Construction orders year on year, terrible, down 18%. Construction PMI, though, weirdly bounced in July. So the construction orders was a quarterly number ending in June. In July, we saw a bounce in construction PMI, although still firmly below 50, firmly in recession territory. UK balance of payments, terrible, minus 5.5 billion in June. The job posting index, going nowhere, but actually not really deteriorating currently. So UK jobs market is weak, but not really deteriorating. Trueflation, and, obviously take all this with a pinch of salt, but Trueflation thinks the UK does not have an inflation problem. So in summary, actually, UK economy has proved resilient, thanks to our strong service sector and in particular the information and communication sector, i.e. AI boost. So as long as that continues, the UK economy is growing at trend and inflation's coming down. Looks all right. On to the EU. So retail sales in June were minus 0.3% month on month, 0.7% year on year, weak. EU consumer not doing well. Industrial production 0.1% year on year. EU industry suffering from competition from China and high gas prices. Construction PMI strengthened to 44.3, but still weak. Indeed, job posting index for Germany continuing to decline. For France, continuing to decline. That looks bad. So jobs market in Europe continuing to fall. EU company profit forecasts for the coming year have strengthened remarkably over the past couple of quarters. I wonder if the US AI boom is leaking out into the whole world economy. But higher oil prices have been very bad for the EU's external trade balance. Chinese car exports won't have helped either. So very little new data for the EU. Bottom line is it's growing at 1.9% year on year. That looks all right. Better than the UK. So actually, EU economy doing okay at the moment, and inflation coming down a bit. So as long as the war in Iran does not cause oil prices to go through the roof, EU economy looking okay. On to the US, much more data from the US. So we had July inflation numbers. Reminder, in July, the war started again, basically, and we had oil prices rising. Well, July still had negative CPI. 3.4% year on year, still too high. You'll see that core has been above 2% for 5 years now. In July, it met expectations at 0.2%, 2.5%. But the drift is downwards despite the disruption from the war in Iran. When you look at contributors to the July CPI report, notice that outside, disruption from the energy markets, there really is not much inflation in the US. No evidence of secondary inflation effects. Although, the AI boom is causing an abnormal increase in computer prices and software prices. All that investment, they've got to try and recoup it somehow. And also, they've been bidding up the price of DRAM, as we've covered many times. Input prices drifting off. That's great news. Core also drifting off. Non-farm payrolls for July were negative, down 23, and also the June number was revised downwards. So the labour market, having had a bit of a rebound in the past quarter, fading again. And when you look at where that weakness is coming from, the government shed 53,000 jobs in July. Most of that is probably teachers. But also leisure and hospitality lost 40,000 jobs. So is that the end of the World Cup boost? You'll notice that construction is still adding jobs. That is good for the US economy. And it is still adding jobs because data center construction has more than offset declines in office and residential. The household survey reported a fall in employment of 87,000 in July, although adjusted, it implied a rise in employment. I'm not sure how it's meant to have been adjusted. As ever, non-farm payrolls continue to be revised downwards after the fact. So the BLS overestimates non-farm payrolls initially and then revises downwards heavily. The household survey has reported falling full-time jobs for actually several years now. So labour market in the US is not as strong as the headlines suggest. And further evidence of that, average weekly earnings growth continues to decline. And that is now perfectly compatible with the 2% target. As worked is stable. Participation rate is really dropping. So 264,000 people are estimated to have left the labour force in July. When you look at the data, we've had a big drop in labour force participation for people 55 and over. Now, is that a function of a rising stock market, allowing older people to leave work because they've got so much money now? US unemployment rate actually ticked down. So despite the fall in non-farm payrolls, more people left the labour market. So the unemployment rate actually fell. U6 was flat. So this includes discouraged workers, etc. ADP employment change was positive but weaker in July. Challenger job cuts, that's perfectly normal. Labour productivity still decently positive, 1.4% annualized. Labour costs, therefore, were subdued, 1.3% annualized. So company profits benefiting from low labor costs after accounting for productivity. Job openings declining slightly. And basically, the US labor market is weak but stable. It's no hiring, no firing, low firing, low hiring, low firing, low quits. The good news is that cyclical payrolls, so payrolls in manufacturing and construction, have been rising again. So the cycle in the US has turned in the past 6 months, and we are once again in a cyclical upturn. ISM manufacturing PMI has strengthened and is now solidly strong, 55.6. ISM services, pretty flat, but still firmly in expansion territory. So PMI is saying the US economy is doing fine. US factory orders weak in June, but everything else shows the US economy just fine. The RCM TIPP economic index, it's optimism index, which is a survey of consumers. Not great, but not obviously weakening. US inflation expectations starting to come down. Hurrah. Small business optimism rising in August. That's good news. And hiring intentions rising. So everything suggests actually cyclical upturn in the US economy. New home sales weak though. So higher mortgage rates in the US are structurally undermining the housing market. Initial jobless claims perfectly fine. Continuing jobless claims low. Indeed, job openings going nowhere. On to the nowcast. So Dallas Fed strengthening slightly to 2.7. Atlanta Fed for Q3, an enormous 5.8%. The Atlanta Fed basically has the most volatile estimates for US GDP. This is the one we like the most, which is the New York Fed, is the most stable. It says a slight weakening to 2.24%, but still absolutely fine. And UK would love this level of GDP growth. St. Louis Fed stable at just over 2%. Lantern Daily Index, actually, we don't have any data. It seems to have stopped publishing the last 6 weeks. Trueflation going nowhere and coming down again at 2.2%. Seems absolutely fine. But the US economy is being supported by an absolutely enormous fiscal deficit. It was a record 423 billion in July. Shocking numbers. So in the first 10 months of the fiscal year to 2026, it was 1.8 billion, more than the whole of 2025. So 2025 numbers were boosted by tariffs, and now Trump has had to give some of those back, that money back, making the deficit for 2026 much worse. So here you see the path of the deficit. Now, so tariff refunds are forecast to raise the 2026 deficit to 2.1 trillion. That is 6.5% of GDP at a time when the US economy is strong and strengthening. And I thought this was an absolutely corking chart. So when you look at the whole economy, excluding computer equipment, software and R&D, it is growing at 0.8% per annum. But the 8% of the economy that is computer equipment and software is growing at 13.8%. So US economic strength is predicated on the continuation of the AI boom. Summary, US economy is doing just fine, actually, supported by AI investment, but we don't think that's sustainable long term. Inflationary pressures appear to be fading for now. Let's see what happens to the oil price. And finally, on to good news. And I thought this is really great news from The Economist. And what this chart shows is dementia rates by birth cohorts. So if you were born in 1895 to 99, so you're, well, you're probably dead by now, but well over 100. They're basically, you had a 50% chance of dementia by the time you were 95. But every cohort, every generation, the dementia rate has been falling. And it has been falling steadily by about 20% per decade over the past 40 years. So back then, 3 in 10 elderly Americans had dementia. Now it's just 1 in 10, a huge improvement. And when you look at the risk factors for dementia, high blood pressure, high cholesterol, obesity, and poor fitness in midlife increase the risks of dementia 20 years later. So essentially, it seems the circulation system is crucial to developing dementia later in life. What you need is good blood supply to the brain. So if you keep fit and make sure that you look after you don't have high blood pressure or whatever, then you massively reduce the risk of getting dementia in future, and adopting a healthy lifestyle in midlife will reduce your risk of dementia later. So concluding comments. Well, thankfully things have calmed down a bit, but we've had bumper Microsoft earnings, which have arrested the fall in global technology equities. Those technical charts from SimonW show, it's too early to say whether the bull market is back on. I continue to believe we're in a topping formation. Meanwhile, the war in the Middle East just is going to drag on. Basically, Iran has made it clear it's not interested in peace, and will keep the straits closed until the US concedes control. Both Iran and the US are relying on time, so as their main strategy. So Iran is basically trying to keep the straits closed in the hope that the oil price will go through the moon and force the US to capitulate. The US is blockading the Iranian economy and hoping that economic hardship will force the Iranians to capitulate. In both cases, the straits remain closed. So watch this space. Wars drag on much longer than anyone anticipates. Just look at the Russia-Ukraine war. Okay, that's it. Thank you for watching. Please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.